Hi, everyone. Thank you for visiting my channel and welcome back. In the last episode of my Living Off Dividends series, we looked at what's in my income portfolio and how I'm generating monthly income. We briefly talked about SCHD as a core holding and three complementary ETFs that are paying me out monthly and weekly. I also looked at some funds in my portfolio that are helping me with capital preservation, and all of these funds are in my SOAR portfolio, which has four goals: to grow income, to battle against inflation, cover my expenses in retirement, give me some flexibility and true freedom, and help me sleep at night knowing that my capital is secured. Now, in episode number 2, I'll talk about SCHD's last dividend distribution and why SCHD is in my income portfolio. So if you could do me a favor, like this video, subscribe to my channel, and keep watching. Now, I know some of you might be thinking, SCHD, why is it in your income portfolio? Aren't there better funds? Well, remember, one of my goals of my portfolio is to grow income. And if we look at SCHD's dividend payout, over the last 10 years, it has grown and it has increased its dividend payout every year. So for me, that's great. And if I look at my SCHD dividend payout history, we can see that last year in March, I received a dividend of $67.86. Now, at that time, that was an all time high. And when I first started out as a dividend investor, I received 86 cents here and $12 here. And I thought, oh, it's still just pocket money. But once I started receiving dividends over $50, it started to become real money. And if I fast forward 1 year, in April, we can see that my dividend distribution was $771. That's essentially a 10x from the previous year. Now, in some parts of Asia, that's rent money. So you can see that in my dividend payout history that the dividends are growing. And I think that's going to continue to happen in the next 5 to 10 years and going to help me retire more comfortably. And so that's one of the reasons why SCHD is in my income portfolio. Now, if we look at the last payout, which was at the end of June, I had 3,300 shares at 26 cents per share that paid me a total of $858.71. Again, a new all time high. Now, in this portfolio, I have a few options. I can buy more of SCHD. I can use my dividend to buy more income in OMAH, or I could put it in funds that will help me save the money for a future purpose or for taxes. So what did I end up doing? Well, I bought more shares of SCHD. In fact, I bought 50 shares at a price of $26.40 for a total of $1,319.75. And I know some of you might be thinking, why did you buy more SCHD? Don't you have enough shares? Well, the answer is no. And some of you might be thinking, well, why don't you just DCA it or dollar cost average then? And yeah, I know DCAing reduces the risk of buying at market peaks because you buy some shares, at low prices, you buy some shares at high prices, and you get the average, right? But shares that are bought at progressively higher prices, what happens is it ends up as the investor deploying funds at higher prices, resulting in a lower average return. And so what does that mean? In rising markets, DCAing may not be the most effective strategy. However, lump sum investing would gain exposure to a year's growth and, more importantly, its dividend income. So in the next few parts of the video, I'll give you some examples of how. And if we look at SCHD's fact sheet for the last 10 years, you can see that in blue, it's its NAV or dark blue, and in light blue, it's SCHD's market price. And in 7 of the last 10 years, we can see that there are positive returns. So if you had done lump sum investing in 7 of those 10 years, you'd have done better than DCA. Now, if I give you one example from last year, and this is from January to December of 2024, the first part is the DCA example. I start off with $1 and I put $100 every month. The end balance results in $1,240, and the S&P 500 is about $1,300. Now, if we look at a lump sum example, same time frame, we can see that having $1,200 at the beginning of the year would have resulted in an end balance of $1,340, whereas the S&P 500 about $1,500. So in this example, you could see that the lump sum end balance is higher than the DCA end balance. And when we look at this chart, it's pretty easy to see that, buying at the beginning of the year through lump sum investing, you'd have had more upside because you'd have bought it at a lower price instead of buying it at a higher price. Also, having $1,200 worth of shares before your first dividend payment is going to yield you more dividend, right? Instead of having a DCA figure of, you might have $300 to $400, and so you're only receiving a dividend off of that amount. So in other words, you just have more firepower at the beginning of the year in lump sum investing than you would in DCA. Now, that doesn't mean that every year you should lump sum at the beginning of the year, because every year SCHD is not going to look like this chart. It could have a higher starting balance at the end of the year. So I think with lump sum investing, there has to be a little bit more strategy, and what are your price targets that you could lump sum? And I think that's the tricky part of investing. Now, some people look at PE ratios. Some people look at 52-week lows as sort of a signal to buy. For me, I don't look at price targets. I look at price ranges, because that enables me to buy within a range and gives me more options of when to buy SCHD. Now, if I look at tip ranks, we can see that the 12-month forecast, they forecast a high of about $35, an average about $30, and a low about 24.5. Now, to go from $27 to $34, historically, that hasn't happened often, so I don't think it's going to hit $34.76. However, I think it's more doable to reach $29, $30, because it did that last year. Okay. So my price range is going to be anywhere between $26 and $27. Of course, if it goes below 25, I'll buy more. But I think right now, SCHD is hovering somewhere between 26.5 and 27.5. So if I can get any shares under 27, I'm a buyer. Okay. Now, this is important for me to buy shares at the lowest price possible, because it affects my dividend yield. And if I just show you a small example of calculating dividend yield, we can see that the formula is the annual dividend per share divided by its share price. So for example, if the annual dividend right now is $1.10, and we divide that by $27, which is the current share price, we can see that the dividend yield is about 4%. Okay. Now, in the next slide, I'll show you, the next few years, as the dividend grows, depending on what your average share price is going to affect the yield. So if you buy a lot of shares under 27 and your average cost is $27, that means your yield on cost is not going to be 4%. It's going to be 7.5%. But what happens when you dollar cost average? You keep raising your average cost, right? And so your average cost may end up someday being over 27. It could be 28. It could be $29, right? So for me, it's important to buy shares as cheap as possible. And I think lump sum investing, or strategic lump sum investing, is one way to do it. And so when I look at charts like this with yield forecasts, I think, wow, 7.5% potential in the next 5 years, and 5 years later, it has the potential to be 14% yield on cost. It makes me more motivated to try to buy as much shares as possible within my buying range. And I really like this quote here: yield on cost is a measure of actual dividend return, and current market yield is a measure of potential future return. So the longer you hold SCHD or funds like SCHD, the more it's going to work for the investor. Okay. So that's one reason why I have SCHD in my portfolio, because I think it's going to do a lot of work for me and help me retire more comfortably as a component of my income retirement portfolio. Well, that was episode number 2. I hope you got some value from today's video. In the next few videos, I'll actually be back in Taiwan, and I'll do a little bit more income breakdown on what my whole income portfolio is paying me, what I'm using to pay for expenses in Taiwan, and how I'm retired in Asia. So if you're interested in things like that, subscribe to this channel, like this video, and stay tuned for future episodes. Right now, I'm still traveling around Vietnam and Thailand, so I'll be about a week or two before those episodes come out. So, anyways, thank you very much for watching this video. See you in the next video. And as always, this video is for entertainment purposes only. It is not intended for financial advice. Consult with a qualified financial advisor before making any investment decisions.